Good afternoon, Campbell McCrary here, Amvest Capital in New York City. Welcome to the Amvest Capital Inc. live webinar with Hemisphere Energy. Hemisphere trades on the venture as HME and as HMENF on the OTCQX. Hope you enjoy today's program. Replay will be available in about an hour after we wrap up, and you'll get it in an email. You can also just go to amvestcapital.com/replays and /webinars, and you'll find it later today. And feel free to send in your questions. Just message them in the question pane of GoToWebinar there, and we'll ask them in real time. Of course, again, Amvest, New York-based specialist investment management corporate finance firm focused solely on the natural resource sector, energy, and mining. We're pleased to have with us today. Oh, and important disclaimer, this call is most definitely for informational purposes only. We're pleased to have with us today Don Simmons, President and CEO of Hemisphere, a petroleum geologist by background, and has a proven track record of discovering oil and gas in Western Canada and internationally. For Hemisphere, geologist at Sebring Energy, private oil and gas company, and before that, 5 years at Encana, working on various projects in Southeast Alberta and Ecuador. And after his formal presentation, we'll be opening it up to Q&A. And yeah, just send in your questions, and we'll ask them, and this will also be coming up with its questions as well. So I see you, think I hear you, and your presentation's up, and you want to right-click on that Apple helpful toolbar, we can get the full view.
There we go. Well, thanks a lot, Campbell. Great introduction. I will sort of let everybody know, you probably hear a few noises in the background. I am out on site today, out in southern Alberta, so got a generator running in the back here. I'm sitting in one of our trailers, and we've actually got a big one of our new pieces of facility showing up in the next hour or so, and so crane's running, and so I apologize if it's a bit noisy. The lighting may not be perfect like my office back in Vancouver, but I think everybody should be able to see the presentation and get an update and can ask any questions at the end. And you know, I can't give a presentation today without at least commenting on yesterday. Certainly an interesting day in the market. Glad I wasn't presenting then with oil down $6. See it made a bit of a recovery here today, and you know, it's been a great run for quite a number of months here in a row. There's going to be some pullbacks through the way, but you know, honestly, my personal view is you know, the deal that OPEC Plus announced on the weekend is a very positive for our path over the next 12 to 18 months. And I think it's an important piece that you know, that oil they have you know, behind pipe, that they have a plan, and they're going to work together to continue to release that into a market that's going to need it as we continue to pull out of COVID and pull out of this lower demand that we've had over the last 15 months. So anyway, overall positive, and I'm certainly happy to walk through Hemisphere, give a bit of an update from the last time I gave an update. I think it was in April. So we were starting to see, I think when I looked back, just touching around $60 oil when I first presented, and I think we were trading around 40-45 cents at the time. So I will say certainly the market has continued to have good sentiment over the last number of months, and we've been continuing to be quite active and execute our CapEx plan for the year as well, which you know, is kind of live happening here behind me. You know, I'm taking this opportunity to come out to the field as well and see our new Polymer project, which has been a big part of our CapEx program here this year as well. And so it's exciting to actually see it for real and you know, see the operations that are going on. So I'll jump right in. Again, how do I get this to go down? There we go. So we, you know, without a doubt, we're a growing company. We're growing our production, we're growing our cash flow, growing our reserves. We are dedicated to continuing to grow the assets and continue to look at new opportunities out there as well. You know, for those that have followed us over the years, there's really 4 core principles or key things that we stick to. One is just to keep things simple, as much simple as we can, both in our operations and in our corporate, you know, the way we run the corporation. We have one core area, large oil in place, 2 different pools there. When we talk about being clean, you know, we really have made sure that we haven't picked up a lot of liabilities over the years. So we have minimal decommissioning liabilities, and we strive to keep as low of an environmental footprint as we can, be that, you know, with pad drilling or pipeline connecting our field. We want to leave the least amount of impact as possible. And one of the most key ones, obviously, is being profitable. So even at low prices last year, we still made money from our barrels, and that's a function of having low-cost operations, which yields high free cash flow, certainly in today's price environment, but also allowed us to make money even in a low price environment last year. And a lot of that has to do with our reserves in our field and our production. We have top tier reserve value on a BOE basis, and we'll dig into that a little bit more as we talk about our reserves. And the last thing is, you know, what makes us unique from other small companies out there in the resource sector. One, we've continued to have an active share buyback program over the last few years. We just renewed that here in the past week. You may have seen the news release. And for an oil and gas company, we're you know, we have a visibility to a low debt situation, or if we choose to, even a debt-free operation heading in, you know, into the next 12, 18 months. If we take a look, just a corporate overview, as Campbell mentioned, we trade on the Venture Exchange in Canada under the symbol HME, and in the US, we've been trading the last number of months now under on the QX HMENF. I made this presentation, or we worked on this last week. Our share price was 96 cents. I think we closed today around 88 or 89 cents, so down a little bit with the price volatility. Insiders are big backers and believers in the company, 13% basic, 28% fully diluted. Got about 88 million shares outstanding and about 108 fully diluted. That gives us a market cap today around 80 million and an enterprise value of just over $100 million. So some of the key numbers and where we're located. So you can see on the map down to on the bottom right. So Calgary's the main city in Alberta, southern Alberta, right on the Trans-Canada's Medicine Hat. So many of our field operators and our operations people live in Medicine Hat, and I'm currently sitting about an hour and 15 minutes north of Medicine Hat. It's about a 3-hour drive from Calgary and open prairie, so a very, very good, easy place to do business in. When we look at some of the key numbers, and as I said, I mean, we will dive into reserves a bit more later in the presentation, but again, some of the numbers to compare back to that enterprise value and our market cap. On a proved plus probable basis, our net present value discounted at 10% is about 211 million, and that's with about just under 15 million barrels of oil equivalent. On a proved basis, and really, I'm a proved reserve guy. I mean, that's something in numbers that I look at very seriously when I'm looking at other companies. $170 million net present value discounted at 10%, and just under 12 million barrels. And then on a blowdown case or a proved developed producing case, our PDP reserves about $81 million, or just over 4 million barrels. So you can see, you know, with the difference between our proved and our proved developed producing, we are actively developing the pools that we have and increasing that producing barrels from our PDP from our proved reserves. Corporate production last in the market about 1,800 barrels a day. Again, we're 99% heavy oil, so pretty much all heavy oil. And we've talked about keeping things clean. I mean, there's the number. For the size of our company and operations, only $8 million of undiscounted abandonment, decommissioning, and reclamation costs. And that's just been a function that we really have grown through the drill bit. We've grown through developing. We haven't been buying a bunch of mature legacy assets that come with many liabilities. And then in Alberta, they have they have a rating system that they use here, the LMR, and again, we're just highlighting at a 9.7 of asset to liabilities. We're one of the top 7 companies in the rating system in Alberta. So great place to be there. So we take a look at Q1 and some of the key numbers there. So we were 1,650 BOEs a day. When we look at just under 8 million of revenue, field netback was 5.4 million, and our cash flow or funds flow for the quarter was 4 million. At the end of the quarter, we exited the Q1 with just over 21 million dollars of debt Canadian. And when we annualize that Q1 cash flow, we're sitting at a very good 1.3 times debt to cash flow. We have been focusing the last basically 18 months on continuing to lower that debt, and we'll continue to do so. It's still a priority. But when we compare ourselves, and this, the bottom graphs here have, I think, another 17 or 18 different companies we're comparing ourselves to. You can see on a funds flow per barrel in Q1, we were top notch, number one, highest per barrel number out there, and not doing too bad on the debt to funds flow as well. We're in the fourth of the top 4 companies there. So certainly in a good situation there. And then how does that reflect to how we trade in the market? That's something that we have here. And again, I think when I presented back in April, we were well off to the right side of the chart, last or second last. So we have gotten better with our trading, and we're sort of trading middle of the row right now, which is okay, but certainly shows lots of room for improvement and lots of room for growth there when we compare ourselves to all the other oily weighted peers in Canada. So looking again, same as I presented before, our targets for the year 2021, looking to average 1,900 barrels a day and exit 2,200 barrels a day. We're looking at cash flows or funds flow of 19 million for the year. CapEx planned is about 6 million, so that leaves about 13 million. And we will be looking to exit the year at about 13 million dollars in net debt. So that gets us down to about a 0.7 times. So looking really good compared to all of our peers out there. When we look ahead to 2022, we're looking to average over 2,500 barrels a day, exit at 3,000 barrels a day. At $60 oil, we're looking at 30 million of funds flow. Right now, we've got planned a fairly minimal CapEx program, about 7 million, which would leave us in a position with 23 million dollars of free cash flow or free funds flow, and it's sitting in a cash position at the end of the year. So certainly in a higher price environment, that's somewhere where as we get into the second half later in Q3, Q4, we'll start looking ahead to 2022 and potentially upping that CapEx program to further develop our assets. Where does the money go? We look at the breakdown for 2021. About 17% goes in royalties of our revenue, 19% in OPEX, 13% hedging, G&A, and interest. CapEx is 16%. So looking at about 35% of our free funds flow. And looking ahead next year, don't need to go through all the numbers. The big drop there is really the lower hedging, G&A, and interest, and that's just a function really of our paying down our debt. So less money going to pay our interest, which equates to without upping our CapEx, goes to more free funds flow. So we have run sensitivities. I don't need to go through all the specific numbers, but you can see even down at $50 oil, WTI, we're still sitting in, if we want to be a debt-free position at the end of 2022, and still really good numbers through 2021. And then on a higher case, a $70 case, those numbers are just bigger. So looking at 36 million of funds flow next year, potentially sitting on 15 million of cash at the end of the year if that's what we chose to do. And really what we're showing here is that the strength of our balance sheet, it really just provides tremendous financial flexibility. So debt repayment is still a high priority, just to again give us all the options that we have out there. Allows us to move some of our internal projects forward, some of our drill programs, some of our other projects we've identified within our existing assets, allows us to continue to look at other acquisitions, whether it's picking up bolt-on acquisitions to where we are, or looking at another area that we think that we could develop to a meaningful production and cash flow base. And then, the other thing out there is really looking at, how do we return more to shareholders? And that's, we are shareholders, so that's obviously important to us. We've continued to be active in a share buyback over the last number of years, but as we move forward, if we don't feel like we're being recognized in the market, share buyback and dividends are certainly things that we'll continue to look at to make sure that our shareholders are rewarded. This slide really is just to show, again, comparing us to a number of our oil-weighted peers, and how do we sit with our cash flow yields, and we've added in here. I mean, it's great if you've got cash flow yield, but are you growing at the same time? So again, a lot of numbers behind this, but what this identifies, we're in the top quartile there of having great cash flow yields, and we're growing at the same time. So these numbers, as we get Q2 out, will adjust a bit. You can see there's some numbers that look kind of funny, and that's through some of these companies that have made some acquisitions, so their production growth is quite high, and they're it's not reflecting in their cash flow yield yet. So we'll I think we're usually putting Q2 numbers out around the third week of August. I think historically that's where we've been getting that out to the market. I think this year is probably very similar to that. So we'll be updating these numbers once ourselves and everybody else has their Q2 numbers out, and they should be quite good. It was quite a good quarter for the Canadian oil and gas business. We had very good oil prices, and we had very good narrow differentials. So overall, cash flows should be quite good. So let's dive into the reserves a little bit deeper here. When we talked about some of the numbers before, just to refresh, the proved plus probable, or the 2P, 211 million, discounted at 10%. Our proven valuation, 170 million, discounted at 10%, and our PDP valuation at 81 million, discounted at 10%. So some of the key things for people to understand about these reserves. We really believe that it is the best way to compare company to company. In Canada especially, there's only really 3 or maybe 4 different companies that do reserves, and they all have a very similar approach. So it is a way for us to really be able to look and compare ourselves to other companies, looking at the assets they have and comparing future cash flows. One thing now to note, I think every company now accounts for all their future and existing decommissioning liabilities, so that's good. That's not hidden somewhere else or outside of the reserves. And again, everybody is putting in for their proven and their probable. They're putting in the development capital as well, so that is represented in there, plus your operating costs, and of course the royalties to the government. And I will note, I mean, these numbers that are quoted on the valuations, in 2021, the reserve auditors used just over $47 WTI, because I mean, this was a lot of these numbers were set back at just after Christmas at the end of 2020, and these numbers, the WTI price tag, don't hit $60 oil or WTI until 2029. So I think given where what we've seen so far this year, and where the fundamentals look, it looks as though that these numbers are fairly conservative price forecast that's built into them. A couple of key metrics to note for us: 2-year average proved finding and development costs of $2.32, so phenomenal. Again, speaks to the quality of the reservoir that we have and the where we're at development. 2-year average recycle ratio of 11.6 times, which is phenomenal. Reserve life index of 18.8 years. That's a long reserve life index. Again, we'd like to get this development rolling with the projects we have, get some more wells, get that production up and cash flow up, and get that value out of the ground a little quicker than the 19 years. But it does show that there are years of production here. And as I mentioned before, when you look at our numbers on a per barrel basis, Our reserves are top notch and probably the highest when we compare to all our different peers. And I believe that's the next slide here, just showing it graphically, that compared to those 18, 19 other companies on a per barrel basis, our PDP, our proven, and our 2P barrels are the highest value. And again, just speaks to the phenomenal asset that we have. Again, though, when you compare us on a reserve basis, and now this graph is hung on proved reserves, and again, I always a believer that in a reasonable oil market, companies should trade eventually towards their at least their proven valuation at whatever price deck you want to use, but that's reasonable. And you can see here, we're still trading quite low. Most of the companies are trading at 1 time or slightly above their proven valuation. And in our case, we're trading just over half of our proven valuation. So again, sort of points to the fact we've got some room to move there. Here's some of the specific numbers for, this is debt adjusted, so taking the debt at the end of Q1, adjusting it to that reserve value, and then we've run a bit of some sensitivity, some price sensitivity. So the blue, I think it's blue, is done at the consultant price forecast, which I talked about being $47 for 2021, going to $60 by 2029. We've then run 2 sensitivities, one at $60 WTI flat going out and one at $70. So I'm just going to focus on the middle part of the graphs, looking there at the total proved area, and because that was where most of the companies were trading at or above that proved value. And for Hemisphere, that equates to $1.69 a share at the price forecast from the consultants. At a $60 environment, it's just over $2. So that gives you a sense of where our reserves value compared to our market cap and enterprise value today. So a little bit more about the assets. So we do have 2 oil pools down southern Alberta. We refer to them as the G pool and the F pool. I'm currently sitting above the G pool at our facility there. So the 2 pools together represent about 84 million barrels of total oil in place. These are conventional oil pools, and to date, about 5% of the oil has been recovered from these pools. And both pools originally were developed with vertical wells back in the 70s and 80s. We came in maybe about 5-6 years ago, started development in these 2 pools with horizontal wells, and then implemented a water flood. And then today, I'm out here seeing for the first time, the next stage, at least for the G pool, is our conversion from a water flood to a polymer flood, and I'll talk a bit more about that in the next few slides. So what makes these projects so lucrative? Why are these reservoirs so great? Well, for one, they are just truly excellent reservoirs. The porosity, permeability, productivity is phenomenal. These pools are delineated, so we know how big they are with the old vertical wells. We have 3D seismic to help us over both these pools. And what helps the economics here, a huge amount, is that the wells aren't, a huge cost, or about $800,000 per well to drill, complete, equip, and tie in. Why are they cheaper? It's because they don't require fracs. We don't have to have a very expensive completion to get these wells on. The other part is, we've invested capital over the last number of years building facilities at both of these pools. So, today, yes, we're adding a big piece to the facility here, and we can expand these facilities. But the bones are there already. The infrastructure is there. It's now just increasing as we need to increase capacity. And from the reserve report point of view, I'll just make a note that the latest reserve report from the end of last year, it does reflect the polymer conversion in the G pool, which we started up a number of weeks ago, put out a release, and but it doesn't include the other pool, the F pool. That's something that we're still evaluating for something to do in the future. So the development plans, here 2021. So yes, we've already converted the G pool water flood to polymer flood. We do plan to drill 3 wells in this pool in later on in the third quarter. The expand G pool facility to handle increased oil production, that's what's happening, or that's starting to happen here today as we speak. And we'll continue to evaluate and look to submit our applications for the F pool polymer flood conversion. Looking ahead to 2022, pretty high level right now. We've put in about a $7 million capex program, and right now all that reflects is 3 more wells drilled in this pool, the G pool, and a 4 well program in the other pool, the F pool. So anything over and above that, we'd have to add to the capex program. So why polymer? It really is a tried and true method of enhanced oil recovery. Really, you're adding this dried polymer to our injection water, and the goal there is to increase the viscosity. So you're increasing it from water to almost something similar to olive oil. And the idea is it pushes the oil through the reservoir more efficiently. So it builds a wall, it pushes that oil to our producing wells, and you're trying to stop any water from streaking through, which will, decrease the efficiency of your flood. So you can see in the diagram there, we got the injection well in the middle, 2 producing wells on either side, and you're just producing and pushing that oil over to those producers. So what we look for in the analogs and what we look for in these pools, increase in oil production, a decrease in water production, so it lowers some costs eventually, and overall we get more oil out of these reservoirs. We get a higher recovery factor. It is very exciting. I'm excited to be out here and having a look at it, with my own eyes. But again, this is, the one thing we do want to get across is not something that's, not happening all over the world. There's a number of other Canadian producers and again, a number of pools throughout the world that have successfully been doing polymer flooding for many decades now. As I mentioned before, we G-Pool the project injection began a few weeks ago, and the modeling we have shows that we should start to expect to see some of these response from this injection within about 6 months. So so stay tuned. One thing I always want to get across when we talk about our environmental footprint and what we do corporately. I'll say from a Canadian energy point of view, every company I know, every CEO I know is committed to the highest standards. What do we do specifically? We've always taken an aim at making sure that we don't have a big decommissioning liability. If there are things to clean up, we make sure we get it cleaned up. We don't use any surface water or fresh water in our EOR operations. It's all produced water. We use natural gas for our power generation. As I mentioned before, we use pad drilling where we can to reduce any surface footprint, and we pipeline connect our fields, so really reduces our trucking and certainly keeps the landowners much happier that there's not a lot of traffic on the lands that they have. We try to, as much as we can, hire local people, support local businesses. We want to have a positive relationship with everyone we work with. Certainly from a governance standpoint, safety is number one. But from the top down, we also want a culture that we've built here of honesty, integrity, and certainly everyone's accountable for what we do. Here's a team. So we've been together for quite a few years now, and been building step by step, building Hemisphere, and we've been backed by a very supportive board with many years and decades of experience in the oil and gas space. So great team to work with, ton of respect for everybody. They all have a unique skill set and a unique role, and it's a fun team to work with, and we've accomplished a lot, and we feel like we've got a lot left to accomplish by continuing to develop these pools that we have. And that's really it. That is the Hemisphere story. We are a small cap, oil producer, but there's big value there, and we really believe in the assets we have. So thank you very much.